Hey, welcome back, guys. How's it going? Another video. That's right. I'm going to keep dropping them until I start getting really, really tired. But there's just some things I want to go over. Tonight, I want to talk a little bit about my portfolio and kind of the moves I did in it. Don't really have it set up to like show you on the screen, but it's almost there to be able to do that. Um, but yeah, I did make some moves. I'm going to tell you what I did here. Let me get into my account. See, that's how off the top some of these are. I knew I was going to go over my portfolio, but this is the first time I'm after hours. Though, hey, I'm up 0.15%, so not probably pretty good. But what I did was when ran up to 88.50. I was not able to continue to fill my position and win because I wanted to fill it out in the 50s. If it drops back down to the 50s, I will buy it again. Again, this is my fun portfolio. This isn't financial advice, not something you should be copying. But when I had a stock that literally ran up 65% in a bear market, um, I wanted to liquidate it and kind of spread it out a little bit through the portfolio. So what I did was is I pretty much doubled my charge point position, which charge point's actually looking like it's going down. I also bought a little bit of Allegiant with it. So I'm sitting with ChargePoint, Robinhood, Allegiant, and Meta, and I'm sitting. Those are stocks I really like, and I will continue to probably add to any one of these. There's also a few other stocks that I would like to get into, but I just kind of wanted to go over at first, just my portfolio. But a stock I really, really, really like. And it isn't a stock that's really actually talked about. Let me bring it up again here. And it's actually UAA. That's right, Under Armour. I see a lot of people wear Under Armour in my area. It's just exploding. In my opinion, it's the best store that I like going into. I also like Hims. I think it's Hims. I don't know. But I really like Under Armour, and if you look at the numbers, this company is pretty undervalued. It's heavily institutionally owned. It has 81% institution. It's slightly shorted. I think 12% in the short. But the top two holders are BlackRock and the Vanguard Group. And they both own. BlackRock owns almost 9%, which that's kind of crazy. And that's like hitting the max almost, and Vanguard is almost up to 9% as well. So, I mean, I really respect the institutional holders, but let's go over the market cap and see here. Now, the things to worry about it is I don't think it really has a CEO yet. I don't think Under Armour has like a solid CEO yet. But and I like it at the $9.50. We're sitting at a $4 billion market cap, and I really could see this. I think Nike's sitting at like a $40 billion market cap, and if you want to compare to how these guys are run, let's do that actually while we're here. Um, Sorry, guys. I guess I should have had it pulled up. But anyway, guys, the revenue to this, they're doing $5 billion a year. They have free cash flow of $800 million. 14% free cash flow margin. They have $1 billion in cash, $800 million in debt, and they have capital of $3 billion, so they can pay off their debt, and they're still fine. Now, like I said, the management team I'm still trying to figure out, but from the way this balance sheet is looking, I'm really I think they have their stuff together, and like I said, I'm seeing a lot of people wearing Under Armour. But let's look at Nike, which, people would talk about Nike. Would be more of the popular stock, but I'm trying to avoid those, and I think I found a better company than Lululemon and Nike. So let's look at Nike. So Nike's revenue is $46 billion. Now, you guys don't think that Under Armour could take second place and be at $20 billion? Let me continue here. Let's see. Nike has $4 billion of free cash flow. They have 13% net margin, 11% operating cash flow margin. They ran pretty well as well. They have $8 billion in cash, but $9 billion in debt, but they have $23 billion in capital. So they could most likely, they're definitely not going anywhere. So Nike has a higher, I still like Under Armour a little bit better. So the revenue of Nike is $46 billion, but they're only bringing in, free cash flow of $4 billion, where Under Armour's bringing in $1 billion. And their revenue's $4 billion, and they have a free cash flow of $1 billion. So, and they're able to pay off their debt a little bit easier than Nike. Nike does have the management team. Nike does have the stand, but I don't think Under Armour's going anywhere, guys. So Under Armour will probably be a buy for me sometime this week, probably tomorrow, to be honest with you. So yeah, there's a couple other companies I also want to talk about. But yeah, I'm probably gonna, let me, real quick on Under Armour. UAA is the ticker, but I think I would like to just kind of get $1,000 into it. So I'm just gonna be nibbling right now. But it's definitely going to probably end up on the public portfolio. Let's see here. Now, as investing, getting into AMC, this is the next stock I would like to talk about. Now, what I like about this stock is the management team has somehow been able to get the public behind this stock. So it's a favorite. I like that it's in the $5 range, because that's kind of when I wanted to look at it. And let's be respectful to AMC. It is the biggest movie theater company in the market. So I like to be respectful towards it. I see them everywhere, and they're busy. Movies aren't going anywhere. People just like going to movies. I found something I would like to compare to it, but let's look into more of it here. So AMC's revenues $4 billion in the past 12 months. Everything I'm doing is on the past 12 months. However, their free cash flow is minus $600 million. So they are bringing in, out of every $4 billion, they're losing $500 million. That is pretty terrible. So there is no cash flow. Might as well just skip through that part. So they have $1 billion in cash. and they have $5 billion, $6 billion in debt. And if they sell everything like the napkins and shit, they'll have $2.4 billion. This company, honestly, Amazon should buy this company because it's popular, and Amazon could easily get this company going. Obviously, the management team, well, they're probably still trying to recover from, the beer virus, or the beer stuff. But yeah, so that's AMC. Now, the company that I actually want to buy is Cinemark. See, everybody would be telling you to buy AMC. But I just went over AMC's numbers. Let me go over Cinemark's numbers. Now, they're not as big, they're not as known, but will they be? Let's find out. So, Cinemark, their revenue is $2.4 billion, so they could catch AMC in revenue. Let's not act like they're that much, doing that much better than Cinemark. Listen to this. Free cash flow, $132 million. Free cash flow. So, out of every $2.5 billion, they're making $132 million. That's better than AMC. Their cash flow margin is only 6%. I like to see that above 11%. But again, if they're able to wipe out AMC, if AMC isn't able to get help, which they will be able to. So listen to this. They have $658 million of cash on hand, and they're not in debt at all. And if they sell all their paper towels and stuff, they have $4.2 billion. So they actually, it looks like they have more assets than AMC actually does. So all in all, man, I'm telling you, Cinemark is a company I'm looking at. The ticker is CNK. I think they could overpass AMC. The only hesitant thing I would say is I do think AMC could get bought out by a company like Amazon, and then it's probably over for Cinemark. But that's a good company too. Another company I wanted to look at, which we kind of talked a little bit about on my last video, was Carnival Cruise Line. So let's look up Carnival Cruise Line. So CNK, will I buy Cinemark? First I'm gonna load up on some Under Armour, and then I'll look into Cinemark. I mean, if I'm gonna buy a movie theater company, which I don't think they're going anywhere, it will be probably Cinemark, but that's just on my list. But Carnival Cruise Line would be on my list as well. It's under the $9, which is what I kind of wanted at. I think that's about where I want it at. Let's see though. So they're bringing in $4 billion. Free cash flow is minus $7 billion. And I don't know if I have to. Oh God! So they have $7.5 billion, but they're $38 billion in debt. And if they sell all their ships and everything, they have $39 billion. So they're barely getting by. I mean, they're not going to go anywhere. I think I would throw CCL out because I like Allegiant. I like Allegiant better, and it's still a travel stock. But let's see what else I got on my list here. Affirm. I see Affirm everywhere. Don't you guys, when you're buying stuff online? It's like Affirm. Like, I don't know. You can affirm everything. And it's down quite a bit. I believe they have a partnership with Amazon too. But I think everybody has a partnership with Amazon. I don't think that really matters. But Affirm, they're bringing in $1.5 billion. They're minus 600 million in cash flow. But keep in mind that's only on $1 billion, $1.5 billion of revenue. They're probably not getting too many more subscriptions at this point. If they can improve on that, I could see them getting into free cash flow here eventually. But so they have $2 billion in cash, but they're $5 billion in debt. If they sell everything, they have $3.5 billion. Yeah, I don't know about Affirm, guys. I think that might have to be taken out. Let's see. What about Adobe? Like, that seems like it would be a safe play, but yeah, no, I would actually probably buy Facebook before I'd buy that. So should I be focusing more on Allegiant? Let's go into Allegiant just a little more here. I don't think we've really done that. So, I think travel's down right now, so, they're sitting at $2 billion in revenue, but they're minus 236, $1 million in free cash flow. They're right there on the cusp of practically making money. So I'm not really going to hate them for that. Again, they have $1 billion in cash. They have $3 billion in debt. This is down, though, and airlines are kind of crazy to be investing in. So, I probably won't go crazy with that. PayPal, but PayPal, well, let's look at PayPal, guys. What do you guys think about PayPal? I mean, I think I could do PayPal. Let's see. Okay. So PayPal brings in $27 billion. They have $5 billion in free cash flow. That's nice. That's real nice. Let's see how 21% cash flow margin. Wow. However, they have $6 billion in cash and they're $52 billion in debt. But they have they still, with they're worth $74 billion. So, they could kind of pay that off. I would still rather buy Facebook. Let's see Robinhood. Like, have I went over, like, are we sure Robinhood's a... We got revenue at Robinhood at $1.3 billion. Keep in mind, the market's dead, guys. So let's... free cash flow, minus $2 billion. That doesn't make me happy. But, however, $6 billion in cash and only $1 billion in debt. So, I mean, yeah, this is still a buy to me. Just off of that alone, you could sell everything and have... This is like a $15 billion company if you sold everything. And the market cap right now is... What is the market cap? $7 billion. So it's still a buy. I don't know why why it has to be below $9 for me to buy, because it's screaming buy to me now more than anything. Now, Tesla, again, that's more of a popular stock. You're not going to hear me talk a lot about this. Real quick, I did say I would buy Tesla at 150. However, I'm not sure if that's exactly the case. There is a strong case why Tesla should be 150. I just don't know if I would buy it unless everything else was up and Tesla was down. Then I would start to add to it. Let me look at my bigger watch list here. I'm just kind of going over a few stocks, to see if there's anything better than Under Armour, and I'm not seeing it, to be honest with you. I'm not interested in Neo. Yeah, no, guys. I think I'm gonna be mostly focused on Under Armour, maybe increasing my positions with the companies that I have. But I do expect to add Under Armour tomorrow. So, but yeah, thanks. A little bit of a longer video than I expected. But anyway, like and subscribe, and I'll catch you on the next one.